Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Ondas.
If you find our talks useful, please consider subscribe, like, and comment underneath. Because today we're starting with a bit of a thought experiment.
A pretty wild one, honestly.
Right. So I want you to picture looking at the books for a business. And you see that they currently have a profit margin of negative 191%.
Which is just, it's staggering.
Let that really sink in for a second. Negative 191%. In almost any normal scenario, whether that's, a neighborhood bakery or a mid-sized tech firm, that is the kind of catastrophic number that precedes a bankruptcy announcement.
Yeah, the doors are closing.
Exactly. The lights are being shut off. But then you turn the page and look at the other side of the ledger. This exact same company is sitting on a massive verified cash pile of over $1.5 billion.
Right.
And they are projecting an unbelievable 582% revenue growth.
It genuinely looks like a typo the first time you see it.
I know. I had to double check it.
It's one of those incredible, almost comical financial contradictions that makes you stop, take your glasses off, and just reread the balance sheets to make sure you didn't miss a decimal point somewhere.
I did exactly that. And that wild contradiction is exactly why we're unpacking Ondas today. This is a company pivoting incredibly hard into the world of autonomous drones and mission-critical networks.
Absolutely.
And our mission today is to sort through a massive stack of data to figure out the reality of this situation. We want to help you understand if Ondas is a strategic, structural powerhouse, quietly building the future, or if we're just staring at a massively well-funded, speculative bubble.
What's truly fascinating here, and why this matters for your wealth-building context, is that this isn't just a story about a stock bouncing up and down.
Right, it's bigger than that.
Much bigger. If you look closely at what they are actually building, it's a window into the near future. We are talking about autonomous defense, border security, and even how we are going to monitor our basic municipal infrastructure in the coming decade.
It's this incredibly complex intersection of geopolitics, artificial intelligence, and private communication networks.
Exactly. It's the physical infrastructure of the future.
So let's jump straight into the numbers, because we really need to unpack this financial whiplash. Let's look at the preliminary data for 2025. Their full-year revenue hit between $47.6 and $49.6 million.
Which, importantly, beat their previous guidance by 23%.
Right. But the really crazy part is the fourth quarter. The fourth quarter of 2025 alone is projected to be between $27 and $29 million.
Which is a remarkable data point.
Yeah.
If you do the math on that, it means well over half of their entire yearly revenue was generated in just the final 90 days of the year.
Just massive acceleration.
Severe acceleration. They aren't just growing. The actual velocity of their growth is speeding up exponentially as the year closes.
And looking at the projections, that momentum is supposed to carry forward. Their guidance for 2026 was just raised by 25%.
Huge jump.
They are now targeting $170 to $180 million in revenue for the upcoming year. And they attribute this to their backlog, which is basically the orders they have on the books waiting to be fulfilled, surging by 180% to $65.3 million by the end of 2025.
So we have to contextualize these massive growth numbers against those shocking negative margins we mentioned at the start.
Right, the negative 191%.
Exactly. The data shows an EBIT margin, that's earnings before interest and taxes, of negative 140.6%, and that net profit margin of negative 191.63%.
It's brutal.
In a vacuum, those numbers are terrifying. They mean the company is spending roughly $2 to $3 just to make a single dollar back.
Okay, I have to push back here just from a practical standpoint. If you or I ran our household budgets like that, spending $3,000 a month to make $1,000, we wouldn't just be broke, we'd be living on the street. A business can't survive that kind of burn rate, can it?
You are entirely right. A normal business absolutely cannot. But here is the crucial piece of the puzzle that changes the entire calculus for an investor.
The cash.
Their war chest. Following a massive $1 billion equity offering, Ondas ended 2025 with a pro forma cash balance exceeding $1.5 billion.
Let's pause there. Pro forma is one of those finance terms that gets thrown around a lot. What does that actually mean in plain English for their bank account?
Great point. Pro forma essentially means as a matter of form, or for the sake of form. In corporate finance, it's a way of showing what the company's financial state looks like if you include a specific, very recent transaction.
Got it.
So the data is basically saying if we count the $1 billion we just raised from selling new shares, here's our new adjusted reality. And that reality is a bank account with $1.5 billion in it.
Okay, let's do the math on that, because $1 billion sounds like an infinite runway.
Yeah.
But with margins of negative 191%, doesn't that cash get eaten up a lot faster than people think?
Let's break it down. If they bring in roughly $50 million in revenue and their profit margin is negative 200%, just to keep the math easy,
Right.
that means they're losing about $100 million a year in pure cash burn.
Which sounds terrible.
It does, but they have $1.5 billion in the bank. So even if they never improve their margins, even if they keep losing $100 million a year, they have 15 years of runway before they run out of money.
Wow.
And on top of that, their debt-to-equity ratio is just 2%, so they owe practically nothing to banks.
Okay, when you lay it out like that, the immediate panic of a negative 190% margin completely evaporates.
Precisely. This unique financial health is the so what of the margin story. Because they have zero immediate debt panic and this massive reservoir of capital, they can afford to operate at these massive losses.
So they're burning cash on purpose.
Yes. They are actively choosing to spend heavily to scale their manufacturing, hire talent, and pursue mergers and acquisitions.
Right, buying up other tech.
Exactly. They can reinvest everything into aggressive growth without worrying about making payroll next month or facing immediate pressure to raise more funds at a bad time.
Which usually means horrible stock dilution for retail investors.
Exactly. Those negative margins are essentially the conscious price of admission for capturing market share at hyperspeed.
So they are effectively trying to buy their way into an unshakable dominant position. But you don't burn through that kind of money without building something highly specialized.
No, you definitely don't.
If you're spending that aggressively to capture a market, you better be building a product that nobody else can easily copy. I was looking through the equipment lists, and they have these incredibly intense, sci-fi sounding names.
They really do.
I'm seeing things called the Iron Drone Raider, the Optimus platforms, and this whole category called drone-in-a-box setups. That includes the Scout and the Raider, plus they aren't just in the air.
Right, the ground tech.
The notes mention acquisitions of companies called Apero Motion and RoboTeam, which bring unmanned ground vehicles, or UGVs, into their portfolio, so they have land and air covered. But what does this actually look like in the real world?
It's important to visualize this because the word drone usually makes people think of a plastic quadcopter you buy at an electronics store to take pictures of your roof.
Yeah, exactly.
That is entirely the wrong mental model.
Not a toy, then.
Not even close. Let's look at the drone-in-a-box concept. Imagine a large, heavily reinforced, weatherproof housing unit sitting next to a critical stretch of railway track out in the middle of nowhere.
Okay, I'm picturing it.
Inside that box is a highly advanced autonomous drone. When a sensor detects an anomaly on the tracks 10 miles away, or when a scheduled inspection is due, the box opens automatically.
No human involved.
No human pilot at all. The drone deploys itself, flies its exact route, uses AI-powered optical sensors to analyze the rail tie for stress fractures, sends that data back in real time, flies back to the box, lands, and mechanically recharges itself for the next mission.
That is wild. It's essentially a robotic security guard and inspector that lives on site and never sleeps.
Exactly. And the real magic here, the true connective tissue that makes this a multi-billion-dollar play, isn't just the physical hardware, it's how these systems communicate.
The network.
Yes. Ondas is integrating these AI-powered autonomous systems with their own proprietary private wireless networks.
The technical analysis mentions something called the Fullmax 2.16s platform.
Right. Fullmax isn't public Wi-Fi, and it isn't your standard 5G cellular data plan. It is a private, highly secure, deeply robust wireless network designed specifically for mission-critical IoT.
The Internet of Things.
Exactly.
So it's basically a highly militarized, unbreakable version of the Wi-Fi router I constantly have to reset in my living room.
That's a perfect analogy. It's a network that cannot afford to go down because instead of buffering a movie, a dropped signal might mean a train derailment goes unnoticed or a border security breach isn't flagged.
The stakes are infinitely higher.
We are talking about networks robust enough to be trusted by heavy rail systems, municipal utilities, homeland security, and active defense operations.
And this is where it gets really interesting for the business side of things, going back to the wealth building context. How does all this tech actually create a competitive advantage? The reports explicitly mention that Ondas is building a wide moat against competitors like Dragonfly.
The moat is built on two incredibly deep pillars. First, there are the software-defined radio patents. That proprietary full-max communication tech we just talked about is legally locked down. Nobody else can use their exact transmission protocols.
So they own the language the drones speak.
Precisely. Second, and arguably the most important factor right now, is NDAA compliance.
For those who don't follow defense contracting, that's the National Defense Authorization Act, right?
Correct. The U.S. government, the military, and border security agencies have incredibly strict, legally binding rules about where the components for their technology come from.
Right.
You cannot just buy cheap, off-the-shelf drones filled with foreign-made microchips and sell them to the Department of Defense. It is a massive security risk.
So you need a secure supply chain.
Exactly. Because Ondas is building fully NDAA compliant systems and combining that hardware with their proprietary secure private wireless networks, they create incredibly high switching costs.
Let me make sure I'm following. You're saying that once a major railway company or a military base installs the Ondas FullMax network across their facility and physically bolts these autonomous drone boxes to the ground, it would be a logistical and financial nightmare to rip it all out and switch to a competitor.
Precisely. It's known as vendor lock-in, but in the best possible way for the company. The frameworks we are reviewing actually give Ondas a growth durability score of 15 out of 20, specifically because of this integrated compliant ecosystem.
Yeah.
They aren't just selling you a drone, they are selling you a closed-loop infrastructure system. Once you are in, you stay in.
So we know they have a massive cash runway, and we know they have a sticky, highly advanced product.
Yeah.
But who is actually buying this right now? What is pushing the demand? Let's look at the market sentiment data.
This is a really revealing part of the picture.
The overall mood for the stock is currently described as neutral with bullish undertones. But the underlying data points are fascinating. I'm seeing this phrase, notable whale cluster buying activity. That sounds like a marine biology term. What does that mean for the stock?
Whale cluster buying is a great piece of trading jargon. A whale is a massive institutional investor. Think a hedge fund, a pension fund, someone moving tens of millions of dollars at a time.
The smart money.
Exactly. And cluster buying means we aren't just seeing one lucky billionaire take a flyer on this company. Multiple massive institutional investors are quietly coordinating large positions at the exact same time.
So they're moving in together.
It's a massive signal that the smart money believes a major move is coming.
And the data shows what is likely driving those whales. We're seeing the stock climb based on fears of international conflicts, particularly mentions of Iran, but we're also seeing some volatile trading with pre-market slides.
To impartially unpack the macroeconomic context here, we really have to look at global tensions purely as market catalysts.
Right, leaving politics aside entirely.
Yes. The data points out that border security demands and international conflicts are acting as massive drivers for the entire defense sector right now. When geopolitical tensions rise, particularly involving state actors or porous borders, the demand for unblinking surveillance and defense infrastructure automatically surges.
I see a note here specifically mentioning a sector rotation into drones and counter-unmanned aircraft systems, or CUAS.
Yes, a sector rotation happens when large investment funds take their money out of one area of the economy and move it into another.
Like moving from tech to defense.
Exactly. Recently, investors have been looking at potential weakness in the broader market. Or perhaps they're taking their profits off the table from the recent AI software boom, and they are moving that capital into tangible, physical defense, and security tech.
They want real-world applications.
They want companies that have immediate real-world government demand. And CUAS is critical to that. It's not just about flying your own drones. It's about having systems that can detect and neutralize hostile drones that enter your airspace.
And alongside those concrete geopolitical drivers, there are also speculative catalysts fueling the fire. The data tracks social buzz and whisper numbers, rumors that are unconfirmed but are absolutely moving the needle.
There's always chatter.
Right, there's chatter about highly optimistic drone market projections from Oppenheimer, and even rumors of allied defense scaling via an entity called Ondas Capital. Whether those rumors pan out or not, they are contributing to what the analysis noted as 96th percentile momentum.
It is a classic setup for elevated trading flow. You have high daily volume, you have whales accumulating shares, and you have global headlines constantly reminding the market why autonomous defense is relevant.
A perfect storm.
But, as with any high-flying momentum play, we have to flip the coin over.
Let's absolutely put the brakes on for a minute, because this all sounds like a perfectly paved road to a sci-fi utopia. But I'm looking at the risk factors, and there are some glaring red flags. The first one that jumps completely off the page is the valuation.
The price-to-sales ratio.
Yes, the PS ratio is sitting at an astronomical 185.1.
Let's ground that number in reality for a second, because that's vital for anyone tracking this for their portfolio. If you are buying a standard blue-chip company, a price-to-sales ratio of 1 or 2 is considered normal value territory.
Okay.
A ratio of 10 or 20 is usually reserved for the absolute fastest-growing software companies on the planet.
So a ratio of 185 is just completely off the charts.
Imagine you are buying a neighborhood lemonade stand. If that stand makes exactly $1 a year in total sales, you are paying $185 to own the stand. You are essentially pricing in over a century of flawless, uninterrupted lemonade selling.
Wow. That puts it in perspective.
For Ondas, a valuation like that prices in absolute perfection. They cannot afford a single misstep in execution for years to come.
And that perfectly explains why there is high short interest among their IT and drone peers right now. There are a lot of people betting heavy money against this valuation. I really want to challenge this execution risk. Can a company that is currently running a negative 191% profit margin actually execute seamlessly on its goal to hit $170 to $180 million in revenue next year?
It is the ultimate bear thesis.
Because building a physical robot is infinitely harder than pushing a software update.
Exactly. With a software company, if you want to double your user base, you rent some more server space. It takes seconds. If Ondas wants to double their drone deployment, they need more physical plastic molds, more silicon chips, more lithium for batteries, more factory floor space.
Shipping containers, supply chains.
It is a logistics nightmare.
And to make matters worse, the data points to near-term volatility driven by Hotter Producer Price Index, or PPI, data. PPI measures wholesale inflation. If inflation is running hot, the cost to buy the raw materials to manufacture these physical drone systems goes up. Doesn't that mean their already terrible profit margins could get squeezed even further?
It is a massive and entirely valid risk. We've seen pre-market slides in the stock price precisely because the stock is highly sensitive to any broad market weakness or inflation scares.
So it's volatile.
Highly volatile. However, the counter-argument, and the reason the stock hasn't just collapsed under the sheer weight of its own 185 PS valuation, comes right back to that $1.5 billion safety net we started with.
The ultimate shock absorber.
Exactly. If they run into severe manufacturing delays, or if inflation temporarily spikes the cost of their raw materials, they have the raw cash on hand to simply absorb those shocks. They don't have to go back to the public market to raise capital at a disadvantageous time.
Okay, so we've looked at the massive growth projections, the proprietary technological moat, the macroeconomic tailwinds, and the very real execution friction of building physical hardware. If you were watching this company, what is the roadmap? Let's look at the timeline.
There is a very clear runway of catalysts over the next 3 months. First, we are still seeing carryover momentum from their OAS Investor Day, which happened back in January 2026.
Still playing out.
Right. Institutional investors are still digesting the long-term technological vision that was laid out there.
The data also highlights upcoming reseller expansions. They specifically name new partnerships with Rift Dynamics and Drone Nerds. That feels crucial because it shows they are actively building out their distribution network rather than just relying on their own internal sales team.
It's a huge step for scaling, but the undeniable main event is going to be their Q1 2026 earnings report, which is expected in mid-May.
Right around the corner.
That is the moment where the rubber meets the road. The market is building a consensus that Ondas needs to show they are definitively on pace for that $170 to $180 million full-year target.
They need to prove it.
More importantly, they need to prove that their massive $65.3 million backlog isn't just a list of promises, but is successfully translating into recognized build revenue.
So, boiling down all the raw numbers, the whale sentiment, the technology, and the massive risks, What is the final verdict from the analysis we're looking at?
The overarching investment thesis synthesizes all of this into a bullish score of 8 out of 10.
8 out of 10. That is incredibly strong given that terrifying valuation and the supply chain risks.
It is. The thesis outlines a two-pronged approach. In the short term, traders see a swing opportunity leading up to those mid-May Q1 earnings, heavily driven by the macro tailwinds and the geopolitical news cycle.
The long term.
The real substantive value proposed is on a multi-year horizon. The bet is on platform scaling. The core thesis is that the global shift toward NDAA-compliant, fully integrated autonomous infrastructure is simply inevitable. And Ondas has the cash runway and the proprietary technological moat to be a dominant player in that massive space.
It is the ultimate high-wire act. We are looking at a fascinating duality here with Ondas. On one hand, you have a company that is burning cash at an astonishing rate, operating with margins that defy traditional business logic.
Defy gravity, really.
Yeah. On the other hand, they're armed with a billion-dollar war chest, a surging backlog of real orders, and a deeply entrenched technological moat in a rapidly growing, highly sensitive global sector. It's a perfect reminder of why you have to understand the underlying technology and the physical realities of manufacturing before you just look at a stock price.
It really is. And as we wrap up, there's one final thread from all of this that I find incredibly provocative to think about. We've spent a lot of time talking about these full-max private wireless networks being used for railways and industrial sites. Up until now, we've relied heavily on public telecommunications companies to build our cellular grids, our 5G, and eventually 6G networks.
That's right. The big public utilities and telecom giants.
Exactly. But as these highly robust, practically unbreakable private wireless networks scale up for autonomous drone fleets, they represent a massive leap in communication capability. It raises a fascinating technological question.
What's that?
What happens when private, corporate-owned wireless networks actually surpass our public municipal infrastructure in speed and reliability?
Oh.
Could we see a future where the most advanced communication highways in a country aren't owned by public telecom utilities, but by the private defense and industrial companies running these autonomous systems?
Wow.
Who ultimately owns the invisible bandwidth of the future?
That is a fascinating, massive shift in how we think about infrastructure to end on. A huge thank you for joining us on this talk. Keep questioning the numbers, keep looking at the technology behind the headlines, and we will catch you on the next one.